Kamlesh was visibly happy after his brother got admission in Canada. His friend Pramod asked him from where did he take the loan. Kamlesh said that he had sold some of his mutual funds to raise money for this. Pramod was surprised. He thought that Kamlesh was investing for a house. He asked Kamlesh as to why he did not take a loan against his mutual funds. Loan against mutual funds? This was news to Kamlesh. He asked Pramod to explain about this to him.
Kamlesh had to send his brother abroad for studies, so he redeemed his mutual fund investment in a flash. When there is sudden need for money, every person usually does this. But some investments are profitable only when you let them be. When there is a need for money, you can take a loan against such investment schemes. Loan against mutual funds is one such thing. Before knowing how many people like Kamlesh withdraw money from mutual funds quickly, let's see how good is it compared to early redemption of mutual funds.
According to a recent survey by Axis Mutual Fund, 48.7% equity investors sell their mutual fund portfolios or investments within 2 years. According to AMFI data, 22.2% equity investors remain invested for 12 to 24 months. Meanwhile, 15.6% equity investments do not last more than 6 months. Only 10.9% equity assets are invested for a period of 6 to 12 months. These figures stand as of 30th June 2023. It is not considered right to withdraw money from mutual funds by ignoring the importance of long-term investment. For that matter, you are also ignoring the power of compounding. Although there may be many reasons for your withdrawal, a loan on mutual fund can always help you. If you need money for up to 3 months to 1 year and the amount of loan you're taking is not very large, then you can rely on your mutual fund units for a loan. Now, mutual fund loans are a form of secured loans. You can take a loan against your mutual fund units from a bank or NBFC. At the time of taking this loan, a lien is created on your mutual fund. This gives the bank the right to possession or acquisition of mutual funds until the loan is repaid. The agreement ends when the loan is paid off. But in case of non-payment, the bank redeems mutual fund units kept as collateral to recover the loan amount. The amount of loan that can be obtained by pledging mutual fund units as collateral depends on the type of scheme you are invested in. In case of equity mutual funds, loan can be obtained up to 50 to 60% of the net asset value. While in case of debt mutual funds, loans up to 85% of the net asset value of the fund can be obtained. For example, if the total NAV of your equity mutual fund is 5 lakh rupees today, then you can get a loan of 2.5 lakh to 3 lakh rupees as loan against it. Many banks also impose a maximum limit on the amount of loan. SBI provides loans up to a maximum of 20 lakh rupees against equity mutual funds. In case of debt funds, this limit goes up to rupees 5 crore.
If you consider there are two options available in the lien thing, one is normal lien and the dynamic lien. I think for the individuals, normal lien is very best thing to opt for rather than going for a dynamic lien. Because in the dynamic lien, maybe if you are a mutual fund investor and you are going for the dividend reinvestment option, and only whatever the dividend you will get, reinvest in that particular growth option, your overall units and your overall valuation will be on the higher side. But I think in today's context, I feel normal lien is very best thing to do and best thing to opt for. So, see, in which cases you should go for the lien on mutual fund, because see, your overall planning, and if you require money for the shorter duration and for any particular contingency or for the emergency thing, then you should not to go for the early redemption and you should try to see the option of lean on mutual fund, because see, might be you require money for a 1 month time or 3 months time, or probably max for the 1 year's time. So in that case, I think the lean on mutual fund will be a very good option rather than going for a redemption. Because see, what will happen if you go for the lean on mutual fund, your money will be intact in that particular mutual fund portfolio.
People often opt early redemption from mutual funds when they suddenly need money. Should they take loan against mutual funds or redeem early? Which situation is appropriate for applying for a loan? The interest rate for loans against mutual funds can range from 10% to 14%. The interest rate for Axis Bank's loan against securities when applied online is 9.99%, while loan against securities when applied offline or physically ranges from 11.5% to 13.75%. Similarly, SBI charges an interest rate of 11.05% on such type of loans. Both EMI and overdraft options are available for repaying the loan. Usually, loans are given as overdrafts. Regular interest payments are required in case of overdrafts. The entire loan amount must be repaid at once when the tenure ends. Alternatively, you can repay the loan at any point of time during the tenure. Now let's learn about other charges that are included in this type of loan. Let's see with an example how taking a loan against mutual funds is better than withdrawing money from it. Now the first option is that if Kamlesh kept his investment active and he needed 3 lakh rupees. He withdrew it by selling his mutual fund units. Assuming that his mutual fund units grew at an estimated annual return of 10% after 3 years, this 3 lakh rupees would have become rupees 3,99,300, which means that it would have fetched him a benefit of rupees 99,300. Now let's consider his second option. If Kamlesh had taken a loan against his mutual funds, instead of selling them, he would have paid an EMI of rupees 9,680 per month for 3 years. This is at 10% interest rate on an amount of 3 lakh rupees. He would have had to pay rupees 3,48,486 rupees with interest over the course of 3 years. If Kamlesh had taken a loan against his mutual fund units instead of selling them, his investments would have remained intact. He would have received returns on them as well. If he did not redeem his units, Kamlesh would have received a return of 99,300 rupees in 3 years. Out of this, 48,486 rupees would have been the interest amount. He would have benefited a total of 50,814 rupees even if the interest was deducted. Provided that mutual funds grow at a rate of return higher than 10%, returns can increase or decrease in case of equity.
So I think rather than going for the early redemption, lean on mutual fund will be the good choice for you. So as far as the charges is concerned, on the lean on mutual fund, there is a one-time charges like probably from 1,000 to 2,000 maximum, and there is no pre-closure charges. There is no annual retention charges as far as managing the lean on mutual fund, and there are various platforms available, and they are very much flexible on the same, and they will give you the lean on mutual fund via a particular platform.
Taking a loan against mutual funds comes with the advantage that your lump sum or SIP is not redeemed. Your long-term financial goals will be fulfilled. You will also benefit from compounding interest. Now let's understand the benefits of compounding. Suppose you invest 1 lakh rupees in a mutual fund. It grows at an estimated return of 10%. Next year, this money will become 1,10,000 rupees. It will become 1,21,000 rupees the next year. Similarly, the money will keep growing every year. In the long run, this return can be more than 10% and even go up to 12 or 13%.
Like Kamlesh, if you need money for a short period of time, then you can take a loan against mutual funds. But you have to keep in mind some other important things. What are those? Well, first, it is not necessary that you will get a loan against all schemes of mutual funds. You can check on the bank's website which schemes are eligible for loans. The second is the number of units of mutual funds taken as collateral for the loan cannot be sold until the loan is repaid. The third, you can create an emergency fund before starting your investments. This will help you avoid any need for mutual fund redemption or a fresh loan.